Sivaramakrishnan Ganapathi, Managing Director with Gokaldas Exports, joins us now to understand that which way things are moving for the Indian garment sector. Mr. Ganapathi, good morning. Thank you for joining us. If I look at the headlines which we are getting from weavers in Tripur, from garment exporters in Delhi and NCR region, from friends and family conversations, one is getting a sense that the sugar rush in the Indian export sector, which was there in 2021 and 2022, is now behind us. In fact, it is becoming more like a glut situation rather than a growth situation. Is it true?
I wouldn't characterize it that way. The sugar rush probably has taken a pause. It has taken a pause for a few quarters, but after that, garments will be in demand again. I think it's only a matter of time before the inventory problem is resolved. If you look at many brands, they have more or less resolved their excess inventory in their system. So it's a matter of time before the demand starts picking up and the brands will start coming and buying. I anticipate that sometime towards the second half of FY24, we should start seeing demand pick up on the back of a good spring 24. That's the hope. And the early signs that the brands are being conservative in buying will also start building up the pressure for spring 24. So my feeling is that slowly it should start catching up, building it up towards the second half of FY24.
Is your business above the pre-COVID level, or it has come back or even below pre-COVID levels?
No. We are way above pre-COVID level. So we've grown significantly in the last 2 years. So we are well ahead of pre-COVID levels. Like pre-COVID, our revenues were 1,400 crores. This year, we are already trending well above 2,200 crores. So we are way above.
Because China is losing?
China is losing. China has been stagnant. China at its peak was $196 billion of exports, apparel exports. Last year, they did $160 billion. So they have fallen from their peak. And increasingly, brands are wary of having overexposure to China. So we are also seeing quite a bit of inquiries coming, which were hitherto being manufactured out of China. So that trend will continue. Probably when the retail demand picks up, it will only accelerate.
At 2,200 crore revenue profile of sorts, what about FY24? What's the number to watch out for? And even margins, they've been between the 11 to 13% mark. Where should we expect it to move from here on?
So our intention is to hold on to the margins at any cost. So we are, we always work towards a healthy margin for the company. And in the long run, my aim is to improve the margins by 1.5%. So that will be by, say, FY26. In the interim, you asked what's the revenue projection for FY24. It's a bit hard to project at the moment, given the uncertainties in the market. We will work towards growth, but let's see how the market situation unfolds.
Yeah, because, if you can give us some color in terms of volume trajectory, what are you expecting? Because as you pointed out in the first answer, there's a bit of a blip coming in from demand as well. If you can talk to us about how the various geographies are looking with respect to US, do you have exposure to Europe as well? Is there any dichotomy in terms of what are you seeing with respect to demand trends in various geographies?
Sure. So if you look at US retail demand has not really fallen, but there is anticipation that it may taper down given the high inflation regime that is occurring there and high interest costs. But we haven't seen much of evidence at the retail level. However, the brands have excess inventory, which has resulted in lower buying. So that's the US market for you. We almost 75% of our exports go to the US market. So we are heavily dependent on US. Europe, on the contrary, is a smaller market for us. We have consciously focused away from Europe. European market now seems to be growing some green shoots, but it's early days. It has historically been very slow. And with the Ukraine war, it was pretty stagnant or negative last year. So let's see how that pans out. We are hopeful that the FTA with UK will get signed sometime soon in a few months. And if that happens, I think, we will start looking at that market very seriously.
When we look at headlines from a Walmart, Target, the mass retailers, they are not giving us a very rosy picture. And I'm using the word, according to them, spring season is nearing, but the spring business time is over.
So I don't anticipate any rosy picture coming from the brands. That's why I said spring 24. That's next year. So that means our production will start somewhere in the middle of FY24. So I see most of the brands being extraordinarily conservative for calendar 23. But this can change on a dime. If the market starts picking up, or if the market starts shrugging off the increased interest rates, and they continue to buy, then the brands may change track and start buying. So we will have to see how that pans out. It's early to call that out at the moment, but I feel that everybody is super defensive. So in that sense, we are at the bottom. And if we are at the bottom, then the good news is we can only go up.
You were dealing with a very different situation, let's say 12, 18 months ago. High inflation, high demand. Now it is drop in yarn prices, drop in fabric prices, and
Yes.
stagnant demand. The scenario is very
Yes.
different. So what does that
Yes,
mean for
indeed.
you?
So raw material prices are low, which is good. So if raw material prices are low, then the finished good products can be priced attractively, and we can see good demand for that. That's good. Higher inflation in the markets is also good, because then the brand margins can be protected. Brands should hold on to their pricing. Historically, garment prices have never gone up in line with inflation. So last year they could manage to pass on the inflation back to the customers. So if they hold on to the prices, the value chain benefits. My feeling is that once the demand comes back, if the interest rate increases don't continue or tapers off, which is possible, then slowly the consumer demand will start picking up. Then I think a higher pricing, which was set last year thanks to inflation, will also augur well for the market in the 1 year and above time frames.
Okay, so just before we let you go, the government also is doing quite a bit with respect to textile parks, etc. What does it mean for your Capex plans? Because you're also looking at expanding internationally, right? UAE, Bangladesh, etc. Would that also add into the margins, given at least Bangladesh is a bit more easier with respect to cost dynamics?
Yes. So in the long run, definitely, once those units come up on stream, definitely it will help our margins. It'll more than margins. I think it'll help our growth, since we will have multiple locations where we can start ramping up. So we are looking at low cost locations within India as well as abroad. And within India, we moved to Madhya Pradesh to set up a unit that's coming up on stream at the end of first quarter. So that will also help us, create low cost capacities. That journey will continue. The government's support through PM Mitra schemes or through various incentive schemes like PLI will also, go a long way in building confidence in the industry to continue to invest more. So our Capex plan, we have not really altered much, because I anticipate that demand will pick up at least by second half of FY24.
So also just wanted to understand, one is about pricing of the raw material being lower, one is about things being, on the demand side, which we've spoken extensively about. But can you just tell us about the supply chain dynamics? Have they become much better? Because in the last 12 months, it was difficult to complete the order on time. It was difficult to get raw material on time. Is everything working smoothly now?
Very smoothly. So there is no problem on the supply chain at the moment. It's all working well. The shipping, logistics, everything is working okay.
Okay, we'll let you go on that note. Appreciate you joining us on the show and talking to us about a whole host of issues, right from margins, demand, how US is shaping up, and perhaps some sort of green shoots is what we'll see by the end of this year, or at least spring of 24, because for now the situation continues to be fairly volatile. And of course, FTAs are something that we all have been waiting for as well. A bit of a pickup in the